Welcome to the Standard Deviations podcast, presented by Orion Advisor Solutions and hosted by Dr. Daniel Crosby, Orion's Chief Behavioral Officer and New York Times best-selling author. Each week, Dr. Crosby interviews a fascinating new guest on a range of compelling topics, from literature to psychology to financial wellness. To learn more about Dr. Crosby's behavioral finance work at Orion, visit www.orion.com.
Hello and welcome to the Standard Deviations podcast. I'm your host, Dr. Daniel Crosby, and today my guest is return guest Clare Flynn Levy, founder and CEO of Essentia Analytics, a pioneer in behavioral data and investment decision analysis. Clare has spent years studying what actually separates elite investors from average ones, not just intelligence, not just process, but how they behave under pressure. She is the co-author of a fantastic new book, Stock Market Maestros, which takes readers inside the minds and decision-making process of some of the world's top-performing fund managers. What I love about the book is that it's less about stock picks and more about psychology, execution, discipline, and the invisible behavioral patterns that drive long-term success. Clare, welcome back.
Thank you for having me.
Yes, we were just talking about the decision process for whether or not to join a podcast. I'm very glad I made the cut. It is great to have you back. And congratulations on the book. That's very cool.
Thank you. Thank you. Well, it's a pleasure to be back because I've been a longtime follower. And Dr. Daniel Crosby is quoted very nicely on the back of this book. And I really appreciate the positive feedback. So thank you.
Well, I'm a believer in what you do. So let's talk about what you do and let's talk about the new book. I love a book with counterintuitive ideas. I'm a sort of a strong believer that a lot of books don't need to be written. And if you're going to write a book, it better be original. And this book is that. One of the most counterintuitive ideas in the book is that many elite investors are wrong about half the time. And I think that would surprise a lot of people. My question then is, why do humans so desperately overvalue being right, even in environments where payoff matters more than accuracy?
It is the case that whether it's a professional fund manager or otherwise, I haven't done the research on non-professional investors, but on professional investors, when you look at do the stocks they pick outperform the market, 49% of the time for the top ones that we vetted using Essentia Analytics framework in this book, Stock Market Maestros, we vetted all these different managers and we came up with a short list of the best, and they were only right 49% of the time, which, as you say, is counterintuitive because you hear people say all the time, oh, I only need to get it right 51% of the time. Well, that would be great, except for that you're not going to.
Yeah.
It's highly unlikely. Look, some people do, but most people who are actually skilled investors, so you don't have to get it right more than 50% of the time to make money and to outperform the index, actually. So it's not saying it's impossible to be an active fund manager and outperform, right? But what is it that those people do that everybody else isn't doing? Is it just luck? And the answer is, well, if you look at how often do they get it right, you might say, yeah, it's probably just luck because they only get it right 49% of the time. But the difference is about how they behave when they're winning and how they behave when they're losing and how big they let their winners be relative to the size of their losers. And that piece of it is deeply emotional. There's a book called Being Wrong that I read recently by Catherine Schultz, and she makes the point that the experience of being wrong feels identical to the experience of being right up until the moment you realize that you're wrong. And then it feels really bad. And the point that it's that moment that is so destabilizing. And it's not so much that like, oh, I thought this and now I know that. It's a disruption to your identity in some small way. So, in a stock situation, it could be about, gosh, I've been talking about this stock for a billion years. It's the, poster child for my way of doing things. And what do you mean it's not going to recover? That my identity is somehow wrapped up in this. And then you're thinking about your future identity and thinking, well, I don't want to be the guy that bailed on them and then it went up 3 times more. After that, I would look like an idiot. So that sort of fear of looking like an idiot in the future plays in. So you start to like be in this emotional dynamic of trying to talk yourself out of the fact that you're wrong and give it more chances and give it more chances. And in the end, this is how you can make a lot of money and then lose a lot of money in the same stock over the same, life of it. It's we're hardwired to not want to be wrong because our brain doesn't like that feeling of that identity disruption. And so we have to try and deal with that, recognize it when it's happening and try and use, computers, which don't have, these emotional responses to help us be more objective and recognize when that's what we're doing.
Okay, so I wanna pull on this thread for a minute because as you're talking, I'm sitting here thinking of, funnily enough, I'm thinking of an argument with my wife, right? Where sort of mid-conversation, that's the better word than argument, mid-conversation, I realize I'm wrong. Mm-hmm. But then I knowingly persist in arguing my case when I know very well that I'm caught, like I'm wrong, yeah. And but by God, I'm not gonna like let it go.
It's like a survival imperative somehow.
Right? Yeah, it is. It's so central to who we are, right? And there's this philosophical sort of thread that runs through the book that markets punish ego. Yeah. And we know how important it is to be humble and overcome overconfidence and be comfortable with being wrong. In your research, in your work, in your writing, how do we begin to get there? And how do we begin to combat something that's so deeply human?
Well, I mean, it is definitely easier said than done. And if you were a fund manager just getting started today, or an investor of any kind just getting started today, you want to avoid the mistakes that you've read all about, behavioral bias, and you want to not fall into those traps. There's no guarantee, obviously, that you're definitely going to experience the same behavioral biases as everybody else. But the question is, do they affect your decision making in the same way that they affect everybody else's? So you do have the opportunity to build, a systematic element into what you're doing and use checklists and use, rules. You can make up what the rules are. It's not that they're being imposed by someone else, but it does require having at least some starting point based in logic or data. So let's say you have a rule that, I don't know, you're always going to start your initial positions at 2% of the portfolio. And the way that you build them is that they have to meet certain criteria for you to build it higher than that. And the next step is 4% or something like that. But there's a checklist for getting to 4%. If it involves activity, and then there's a checklist for what do you do when if it's got there by performance, what do you do when it gets there? Like asking yourself certain questions over the life of the position. But just because you set it at 2% and 4% on day one does not mean that that's right. That was your starting point. So you need to be prepared to go back and revisit these assumptions that you made or that you have been using. If maybe you're not just starting out, you've been managing money for 20 years and you've always done it in the same way because that's how the guy who taught you how to do it did it. And, it's just how you do it. It's like, okay, well, how about measuring to what extent is that actually the right way to do it for your clients and in your situation? Some people will find that they have a tendency to build positions slowly when they should actually move faster because they're usually right and they should lean into that at the beginning. Other people might tend to be early on things and actually they would benefit from stepping in and being more deliberate about how they build their positions. And it's really just a question of doing analysis on your past behavior and then being prepared to look in the mirror, the data mirror, and be like, okay, I'm not perfect. My identity might be that I'm an amazing investor, and the data will show, if you are at all an amazing investor, it will show some things that you're good at. So it's not all about, it's a bit like going to the doctor and getting your blood work done. There's plenty of stuff that you're like, okay, I'm good on all these things. Is there anything that is worth actually having a closer look at on there? Because if so, you can get extra tests done and do something about it. And the same thing goes for investors when they're, when they're analyzing their own decision making. If they really want to be good at it and unbiased in their decision making, that's what they do. And that's what not everybody, and the stock market maestros are not all clients of Essentia Analytics. It was done in a very objective way, but some of them are. And those guys all talk about it in their book, the different rules that they've put in place. We just did the blood work. They're the ones who are taking the medicine, but it does help them.
In the behavioral investor, I put forth this framework that I call RBI because I love baseball, but, rules-based behavioral investing. And I make the case for about half of the book that, rules beat intelligence. Mm-hmm. But I know for some of these stock market maestros, for well-compensated, well-educated money managers who might feel like masters of the universe, this idea that intelligence is the thing or feel is the thing and not rules. Like rules feel banal, rules feel basic, rules feel unexceptional. How do we convince everyone from mom and pop investors all the way to hedge fund managers that rules are the thing when sort of intuition and gut feel tells us that it should be personal greatness and personal intelligence?
I mean, the irony is that if it's a very experienced investor who hope there aren't a lot out there thinking that they're great when they haven't got any experience at all, but the ones who have been at it for a long time and believe that it's all because of them, maybe. They do have rules. They don't realize it, right? Like they have heuristics that they've developed over many years. And sometimes it's really hard for them to actually verbalize those and put them down on paper, which is kind of interesting. But usually when you press them and you sort of pick at it a little bit, they're like, oh yeah, okay. I always do this. I'm prepared to hold a position for this much time. I'm prepared to lose this much money. If it acts like this, I always do that. It's like, there you go. So you do have some rules. Have you tested those in actually give them a good shake and just make sure that are they as valid today as they used to be? Like math can tell you. The data exists to be able to tell you maybe the market's changed an awful lot. The composition of the market has changed very dramatically in the time that this person has been running money. And so the game has changed. So should your rules for playing it change? Arguably, it's worth being open to that, at the very least, and having a look. And that's where, for the sort of work we do, and I think if an investor can't be humble enough to say, yeah, okay, fine, I'm curious, I want to see what I look like in the data mirror, I wouldn't give them my money. I don't think anybody, whether you're talking about a financial advisor or a fund manager or, your buddy, like whoever it is, somebody who's running your money should be somebody who is prepared to be honest with themselves about what they're doing that's helping and what they're doing that's not helping, and be prepared to put rules in place that will make you more money. And if they're not, probably best not to give you their money, not to give them your money, because there are plenty of other people emerging who are willing to do that and are honestly trying to be the best money manager they can be. And why not give your money to those people? Because they're going to try harder. That's the reality.
So I wanna keep with this theme a little bit, because this is one of the most difficult things to know. We know two truths, right? We know on the one hand that the world changes. Like things change and realities change from time to time. And, when the facts on the ground, I change my mind, sir. What do you do? Sort of thing. But then we also know that there's this idea of new era thinking. And, here we are, summer of 2026, and I think there's a lot of a new era thinking going around, and there's people justifying really high valuations and things like that based on this idea that this time it's different. I interviewed Jim O'Shaughnessy years ago on the podcast, and he talks about, I asked him, had this storied career, and I said, what's the proudest moment of your career? And he said, maintaining my discipline, maintaining my rules in the great financial crisis, when about 70% of my peers were abandoning their rules that were based on these sort of timeless principles. And they're like, well, I guess things have changed. Actually, it may have been the dot-com bubble, actually. Yeah. So, when people were abandoning sort of these first principles. So holding these two truths at the same time, sometimes markets do change. And, there is such a thing as alpha decay, as you write about.
Mm-hmm.
But also times of great enthusiasm are the times at which this new era thinking tends to enter the discussion. Mm-hmm. And we abandon our rules at precisely the wrong time. Mm-hmm. So how do you think about knowing when alpha has decayed versus just you're holding on to a true principle that has fallen out of favor momentarily?
Well, so I think that, it comes down to whose money are you running? Mm-hmm. You have a different responsibility if it's your own money than you do if it's somebody else's money. And that somebody else has their own emotional state to deal with when they're looking at the balance of their account. And, they might suddenly say, yeah, I know I told you that you were fine to invest for me in the long term and that there would be drawdowns. Statistically, that was going to happen sometimes for long periods, but I make it stop. I don't like it. I've got to pull my money, or there's some other reason you've got to pull your money. And it's like, okay, that does affect your ability to make decisions in the portfolio. So you have to be realistic in the first instance about the real time frame that the money you're running has on it. And don't fool yourself into thinking that just because somebody says they're with you for the long term, if they have an option to pull their money, they feel pain up to a point that they can't bear it as well. So they will do it. And a lot of managers are feeling that right now, particularly if you're like quality growth managers, for example. So getting that right in the first instance is important. I think, though, a really important piece of it is that everybody focuses their investment process on the beginning, right? Doing the research to pick the stock and then like that sort of heavy lift before you commit to the position. And there's a lot less that goes into the decisions that happen after that, about how you build it, how you add and trim, how you get out, when do you get out, how are we going to know it's time to get out? It's like, oh, it's just going to compound forever. Well, nothing compounds forever. Like, it doesn't matter if it's a timeless principle. That has always been the principle. Nothing compounds forever. So therefore, there will be an end to the alpha generation of this stock. How will we know when that happens? And let's get that clear. Now, you might say, well, we'll know because they'll start missing earnings. Okay, well, let's turn that into a sort of measurable, like a SMART goal. It's like, okay, how many times do they have to miss earnings and by how much? Or, if that's going to be your thing. What a lot of people are dealing with right now is the fact that the markets are very momentum driven. And there's a question mark over how temporary is that as a phenomenon. So you've got these fundamental investors who are like, the stock is just rolling over because of AI fears. And then the momentum is hammering it. And it's just getting worse and worse. It's totally overdone. Now, in that case, fine. You can carry on holding if it's depending on the size of your position, right? And so there's a piece around that goes back to that idea of payoff. You need to be sure that your winners are winning more than your losers are losing. And that means that if you have this very high conviction position that's rolling over and the momentum is hammering it, like you might actually have to trim it back. You don't have to get out of it completely, but you might want to rethink how big are you? Because if this momentum carries on, it's just going to become a bigger and bigger hole in your portfolio. And if it's already one of your biggest positions, it's going to be problematic. And I've seen that happen to people recently where they're like, but I keep buying it because I'm that much more convinced as the price goes down and down. It's like, well, you need some position sizing rules to just, keep it clean because you will ruin your business if you take, too much risk. And you might well be right in the end, but you're dead. So that doesn't help.
So congratulations, you were right.
Yeah. You were right, but you got fired, unfortunately. Yeah. So I mean that there's a need to actually think about what is our process for knowing when, maybe don't say when we're wrong, but knowing when the risk is on the downside for this position for the foreseeable future. Like that's not worth ignoring, actually. Like that, if that's the case for this position, you should do something about it. And it doesn't necessarily mean you have to get out, but you need to resize that.
So with the stock market maestros, tell us quickly what sort of warranted include, what boxes did one need to tick to become a stock market maestro? And then I'm curious, what were some of your favorite rules? What were your favorite quirks or rules or discoveries about what these maestros did differently?
Well, okay. So we started by going through Morningstar and awards, like all the different fund management awards. And this was only equity funds, but not necessarily mutual funds. It could be any equity, public equity strategy. And we looked for funds we already know. We already have a database of 300 odd, skilled managers. So that was a good starting point. But then we went through Morningstar and we found, okay, who's, award winning and therefore deemed by the world to be good. Let's look at all of those. And then we went out to all of them and said, okay, I think it was 73 of them in the end. We said, all right, give us your data. We'll give you an analysis. This is your daily holdings data going back. I think we asked for at least 3 years, but if you were serious, you may as well give us your data going back as far as you can, because we will give you an analysis for free on the back of this. And it will tell you, here's the types of decisions you've been doing well. Here's the things you've been doing that are screwing you up. We can talk more about that if you want to, or never see me again. Either way, you got something that's worth a lot of money for free. Some portion of these people did this, but in the end, we had 73 of them. And then we picked them based on three stats primarily. The hit rate, which is actually, in and of itself not important, but the point was that in the book prior to this, called The Art of Execution, Lee Freeman Shore found that in the end, managers didn't get it right more often than they got it wrong. It was how they behave when they're winning and how they behave when they're losing. So we looked at the hit rate, but that wasn't really a key thing that would decide whether you got it or not. We looked at the payoff ratio. So if the hit rate is what percentage of your positions actually outperformed, the payoff is what was the average outperformance of your average winner divided by the underperformance of your average loser. So how much alpha did your average winner make versus how much alpha was destroyed by your average loser? That needs to be over 100% in general if you want to make money. But we were looking for people with high payoff because we know that's, I have years of research to back that up. But the third thing is called the behavioral alpha score. And that is looking at the different skills, the different decision types involved. So the first two are looking at the position level, what percent of your positions make money and how much do they tend to make? This is saying, okay, well, if we decompose every position you've ever held into 7 different types of decision, picking decision, entry timing decision. Scaling in is about, how fast you build your position. Size adjusting is like adding and trimming. Sizing is about like, why don't you just have an equally weighted portfolio? You could do that and your life might be easier. Or is the way you size your positions actually adding value? Size adjusting, scaling out, and exit timing. So these are all different things. It's like, if you think about it in a sports sort of way, it's tennis season-ish. I think of it as strokes of a racket. Each one of them is different. You're probably not awesome at all of them, but you can't be terrible at all of them. And actually, you can't only be good at one. You gotta be decent at least in the other one. So let's have a look at them. And then we boil that up into a single score, which 50 is sort of your decision making is what would be achieved by chance. Like, it's not actually adding or destroying value. Over 50 means you've been actually adding value through your decision making versus what would have been achieved by chance, and therefore you're skilled. So it was the combination of those three stats, but then we also did a little bit of extra digging on the sort of finalists to say, let's see how they behave when they're winning. When you're adding to a winner, does that tend to be a good decision on a 6-month forward-looking view? Or when you're adding to a loser, or when you're trimming a winner and trimming a loser? That's an analysis that we could do as part of our repertoire. So it's telling, and so this way we were able to say, okay, these people really are demonstrating the qualities that Lee had written about in The Art of Execution, which was, people who don't cower when things are going wrong and just like freeze. Like, they might add, they might trim, they might do something, but the sort of not making a deliberate decision and just sitting there, that's not the answer. The deliberate decision might be to not add or trim, but it needs to be that you make a decision, and you think it through. You might be right or you might be wrong, but at least you did your work and you can justify it down the road. And you could also look at, was I right? Am I good at that? Same thing when you're winning, there are points where you need to take stock and say, how much juice is left in this? How do I know that? What am I holding it to the same standards I would hold it to if it was the first day of its life in my portfolio? Probably not if it's been making you lots of money. So, building in extra steps at that point is key. But anyway, we could see all of this in data, and then we could say, okay, these are the people that we're going to use as our maestros. And it turned out to be a very diverse group, like all different types of strategy. They don't all do the same thing. They don't, some are short term, some are long short, some are long only, all sorts. And I think even so, there were definitely themes that came out, amongst them. Obviously, discipline around cutting losers and running winners, like that was the thing that you could see in the data. And so it makes sense that would have been a theme. But there was also that sort of, that continuous improvement sort of mentality was a big one. Like that, I would have assumed, I would have guessed that would be the case. But it was good to see that whether or not they're using, our analysis, they had measures or have measures in place that are about checking whether something's working and then trying to make it better and still sticking with your investment philosophy. So it's not that you're changing what you're doing all the time. You're staying with the philosophy, but the process is being constantly upgraded because you have data-driven feedback loop of some kind. So those are the two overarching themes, but there are lots of quotes in there that people, they all had their inspo from various, financial forefathers, and lots of quotes that come up over the book. And you learn something from every single one of these chapters, I think. And for me, thinking about which one would I give my money to, if you had a choice of all of them. Yeah, I mean, they're all good. So it's not like there's one is the best. There's not a right answer. And I guess that's the moral of the story for all investors. There's not a right way to run money in the market. you have to figure out what the right way is for you, but then you do need to create a framework around it that keeps you on the straight and narrow, because you are not impervious to emotional decision making as much as you would like to think that you are. You're just not.
So from your work at Essentia, from writing the books, studying these maestros, in a nutshell, how would you say investment skill, as you measure it, differs from investment skill in the popular imagination? Because I think that begins to answer the question, who do I give my money to? How does investment skill? I mean, you're very empirical with how you bring all this to bear. How empirically is investment skill different than how we might, popularly imagine it while we're watching Billions or something?
Well, so in practice, I think people make decisions about skill, identify a good fund manager by looking at their recent performance, right? Even though it says past performance is not.
Right.
It's like that the number is sitting there. And so you're looking at that. So there's that. There's the narrative. So that what that person, you maybe watched them on videos, or you've heard them speak, or maybe they're sitting in the room with you and giving you the narrative themselves, but they're good at narrative usually. And so you're listening to what they have to say and building trust in them as a steward of your capital. Like, that guy knows what he's doing, definitely. Just because somebody is good at narrative, or even, if everything he's saying is super intelligent and like spot on, that doesn't mean he's necessarily the best portfolio manager, because it's two different things. Like the narrative is the stock picking decision. Why am I in this stock? It's because of this. But the rest of it, the timing and the sizing decisions that you're making, the balance of things in the portfolio, it's not an interesting narrative. Nobody's going to talk about that on CNBC. And so nobody really thinks about that aspect of the job. You think about that guy who knows everything about these companies, or he's ahead of the game on where things are going with AI, or, whatever, that he's super smart. Therefore, he's a good fund manager. And it's like, that's not necessarily true. And actually, sometimes the people who are really good are like terrible at narrative. There's a lot of neurodivergent people running money in the market who are very good at it, and they're just not the ones you're going to see on CNBC. And yet, depends, what are you trying to get? Are you paying for narrative, or are you paying for returns? If you're paying for narrative, that's cool. But be clear with yourself.
I think about that a lot with respect to the hiring process. The way the average company hires someone who's going to be, do whatever at your company, be an analyst or something, that would require effectively no narrative skills at all.
Right.
And then you bring them in for an interview and ask them to be charming and narrate their lives. And, it's like, you're not measuring what you want to be measuring. So, not falling prey to that when making fund manager decisions is I can see why that's huge.
So it's so hard, because our human brain wants narrative. We love
so
it.
hard.
Can't help ourselves.
We love narrative, and we think it extrapolates to a million things, and it doesn't necessarily, but we're wired for story, absolutely, for many, many hundreds of thousands of years. So my last question here is also a new business idea for you. Okay. So this one's free. So
Great.
You have your behavioral alpha framework, which measures decision quality instead of outcomes alone. We know we're supposed to trust the process. You're measuring the process. You're measuring the decision quality. We know you can be right for the wrong reasons and wrong for the right reasons, and all this stuff in the markets. But that, again, sort of defies how we think about this. I was thinking this in a more personal context. How could we apply this to parenting or relationships or leadership? What do you think we discover? So this is your next business, right? After you sell Essentia and you make your billions, you're going to now come up with a parenting quality decision-making thing. So I can plug in, when my teenagers bring me a hard thing, I can plug in the situation and you can help me make this. So I guess my question is, how do you apply the lessons of Wall Street, the lessons that you have learned about quality decision making and trusting the process? How do you bring this into your relationship? How do you bring this into your parenting? Where does this show up in your personal life, I guess?
Well, I am a big fan of the checklist, as you know, and I think, AI is your friend when it comes to the thing that stops most people from having a deliberate and rigorous process for making decisions is it's a pain to write it all down and find the document where you wrote this down before. But you have AI now, like you could actually, if you wanted to, just build a skill that's like decision skill and tell it, here's how I want you to make, I actually did this Decision OS. It's still an experiment, but it's, there's a lot of literature out there about decision making that you can leverage, and you could create your own little app for it. But, are you really going to whip it out and start doing it every time your kid comes up to you with a problem? No, you're not. You're going to go back to your heuristics and your emotional response. And if there's something very quick and easy to remember at hand, a very simple algorithm, that's probably the right answer. So I guess the moral of the story in terms of how we work with clients at Essentia is if you make it too complicated, you're not going to do it. You need to make sure that you're keeping the process simple enough that you're actually going to follow it. And then I think the other piece that's harder in life outside the markets is the influence of the relationship on the decision making. And that does exist in the markets as well, right? I mean, I was telling somebody the other day during the financial crisis, that was one of the big takeaways for me, was watching how people behaved with regard to the relationship with the counterparty, like the sort of, don't you pull your balance or you'll never do business with this bank again. And there was a lot of that going on at the time, and you didn't know which bridge to burn. You knew you had to burn one, and it was complicated stuff. So that does exist in business. Of course, the relationship ends up being a factor, but in personal life, it's like a huge, huge factor. So somehow the job becomes twice as hard. It's making the decision is in some ways the easy part. It's then conveying the decision in a way that doesn't ruin the relationship. That's the hard part. And we were just talking about this. I can't claim to have figured this out, and my own family has accused me of being a robot. This is before AI, which is really worrying, because I will be like, well, show me the data about that. You think that's true? That you've emptied the dishwasher more times than me? Show me. Let's keep track and let's see the data. And if I'm wrong, I'm totally open to being proven wrong, but I'd like to see the data. That gets you called a robot, so don't do that. But there maybe are ways of saying, well, here's how we make that decision. Here's the algorithm, full transparency. Like my kid wants to go to a Kid Cudi concert at Madison Square Garden tomorrow. And he's the same age as your daughter. He's a junior, just finished his junior year of high school. And we live outside New York, so it's not like that's a huge journey or anything like that. But it's also like a bit, I'm a mom. I'm still a little worried about such things. So I have to have a sort of algorithm for like, okay, what time, how are you getting there, who's going, I mean, you're doing it anyway, but if you can then be clear with them, this is the basis on which I made this decision. It didn't pass on this.
Yeah.
And at least they know it's not about you being mean.
Yeah, it's not arbitrary.
It's not about that at all. It's like, bring me these boxes ticked, truly ticked, and we can talk.
Yeah.
Yeah.
So
you might be called a robot for doing this.
So I have definitely consulted AI for parenting decisions. So I'm a robot like you, but I am going to go build a little Crosby decision OS, because I think that is really brilliant. And And, I am a big believer that the quality of your life over the long run just sort of is a reflection of the quality of a million little decisions that you make every day. And so why not use the literature? Why not use the technology we have at our disposal to build, a little thing you can keep in your pocket to help you make big decisions? I love that. I'm taking that away from this.
It frees up bandwidth. Like, imagine the cognitive load of making these decisions and weighting these factors and remembering what question to ask, like what matters here. If you don't have to think about any of that, that's like free time.
Yeah. Well, Claire, thank you for coming back. The book is Stock Market Maestros. Go pick it up. Connect with Claire online. Where can folks find you and your work if they want to learn more about what you're up to?
Well, there's Essentia-Analytics.com. That's my company's website, but I am on LinkedIn and also on Instagram at Clare Flynn Levy. So yeah, come and find me.
All right. Thanks, Claire. Thanks for being here.
Thank you.
Thanks for tuning in to Standard Deviations. If you can't wait till next week for more behavioral finance insights, visit www.orion.com. All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by Orion and its affiliates, subsidiaries, and employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.